Hey folks, welcome to a portfolio review at Finominal. Today we're going to review State Street's Strategic Growth ETF portfolio. Now, as per its name, this is a strategic portfolio, which simply means that the allocations are for the long term and State Street only expects to rebalance this portfolio on an annual basis. It's also a growth focused portfolio, and we can see that via the holdings, in a sense that growth simply means it has a very large exposure to equities. Now, this portfolio has kind of 11 holdings, including cash, and we can see the largest allocation is simply to the S&P 500, which is a 39% weight. And then there's two further large allocations, one to developed ex-US and one to emerging market stocks. There's minor allocation to bonds, mid cap, small caps, real estate, and also like a 2% allocation to commodities. Now, if you look at this portfolio and we want to see how this has performed, the kind of auto-suggested benchmark is a global 80-20 portfolio, which is simply comprised of the MSCI, ACWI, and US investment grade bonds. Now, we can see that State Street Strategic Growth ETF portfolio has tracked this global 80-20 portfolio pretty closely. It's almost identical. And well, you can see the X returns were sometimes positive and kind of has been eroding lately. Now, that's with regards to this portfolio from a benchmarking perspective. We can have a quick look in terms of risk, where most of the risk is coming from. Over here, we see the betas to the major asset classes, and as mentioned, it's a growth-focused portfolio, right? So we do see that the beta to the S&P 500 is consistent and well, around 0.7. You do have a consistent exposure to bonds, slightly positive commodities, and also some foreign currency exposure, right, through the EM and international allocations, which results in a negative exposure to the US dollar. From a risk perspective, this is well, very close to an all equities portfolio, right? You do see that pretty consistently, right, over the last 10 years, almost all of the risk can be attributed to the stock market. And there are minor allocations, as mentioned, to REITs, commodities, and so on, but they're just too small to matter. Now, that's in terms of this portfolio from a risk perspective. We already covered benchmarking. If you wonder if this portfolio is diversified, it is not, right? So here, for example, looking at the correlation to the S&P 500 over the last close to 12 years, it's 0.99. So it means if the stock market goes down, this portfolio goes down. If it goes up, it goes up. Correlation to bonds is minor. But to be fair to State Street, that's also a function of this being a growth-focused portfolio. And State Street has the same portfolio in different versions, where there are also ones that have a lower weighting to equities and a higher weighting to bonds that would be considered more diversified. Now, the final question that we asked is, can this portfolio be simplified? As mentioned, there's about 11 State Street ETFs in here, and we can, well, effectively simplify that just into two holdings. Here, the ACWI and a kind of like cross-asset ETF AOR. From a fee perspective, as mentioned, State Street's portfolio is cheap with 7 basis points. The kind of simplified portfolio is 23 basis points, so you could argue it's significantly higher. Having said that, at 23 basis points, 7 basis per annum, that becomes very marginal, right? If you compare the equities risk in here, right, moves easily by 50 basis point per day, right? So at some point, fees become a little bit almost irrelevant. And the simplified portfolio actually had a higher CAGR, so it kind of was almost worth paying that. Another way to simply replicate that is simply by giving a larger allocation than 60% to ACW and allocating 20% to AGG. And this kind of already concludes our very short portfolio analysis of State Street's strategic growth portfolio. As mentioned, it consists of 11 ETFs. It is very cheap with some basis points, which is great, but it's also overly complex. These minor allocation to REITs, 2%, to commodities, 2%, they just don't matter. And the simpler portfolios are the easiest to manage them. And so you can basically replicate that with 2 funds. Hope that helps. Have a nice day.